Hello, Ghost Traders. This is Angelique with your market update for the week of April 27 through May 3rd. And I hope you're fueled up with something caffeinated because we've got a lot to unpack here. We're going to talk about what actually happened in the markets last week, poke around a couple live charts together, and finish with a handful of landmine headlines we need to sidestep over going into next week. First things first, on Friday, the S&P 500 clocked out at 5,686.67. The Dow closed at 41,317.43, and the tech-heavy Nasdaq finished at 17,977.73. Translation: despite tariff drama and headline whiplash, the major averages were downright resilient. The VIX even cooled off into the high teens by Friday afternoon. And earnings helped. Apple dropped the mic on Thursday with revenue at $95.4 billion, an EPS of 1.65. Services are up double digits. iPhones, they're nice. Apple TV and iCloud, nicer. Meanwhile, Amazon showed us $155.7 billion on the top line, pretty impressive, but North American retail margins felt the sting of those higher import tariffs, so guidance was still a little cautious. Cloud and ads are still basically printing money, though, so this is why Jeff Bezos sleeps so good at night. Now, gold bugs had a field day. That yellow metal settled at $3,263 an ounce, while silver shined at $32 an ounce. Anytime tariffs dominate the headline stack, safe haven demand lights up like a Christmas tree, and that's exactly what we saw. Quick stop in crypto land because my update's not complete without it. Bitcoin spent the week orbiting the 97,000, 98,000 neighborhood, teasing that six-figure level like a popular kid at prom. XRP is staying at the 2.25 area. Ethereum chilled just under 1,900. And yes, for the meme faithful, Dogecoin still twitches every time Elon drops a rocket emoji. We're on him in a minute. Now for some fundamentals that we just cannot ignore. Friday's jobs report put a little wind in our sails at 177,000 new payrolls, and unemployment is steady at 4.2%, so pretty solid. On the flip side, the first look at Q1 GDP came in at negative 0.3%, a tiny contraction blamed on import surges right before those tariffs took effect. So growth is down a hair, jobs are still up. It's a mixed bag, but we've traded through worse. And inflation, meanwhile, it's behaving for now. Headline CPI is running 2.4% year over year. Core sits at 2.8%, and the Fed can live with that, even though Chair Powell did warn last month that tariffs could actually nudge prices higher while pinching some growth. In other words, the dual mandate is getting pulled like taffy. And that sets the stage for the next FOMC meeting, which kicks off on Tuesday morning and wraps on Wednesday. Rates stayed at 4.25 to 4.50 in March, and futures traders are betting that we stay put again. But the statement and press conference always carries surprise potential. So mark your calendars for Wednesday afternoon. Now let's pull up a couple of charts. We're going to look here at the S&P 500. Okay, we're going to look here at the S&P 500, and we're going to look at the 50-day moving average. So sitting just under 5,600. You see that yellow line, and that's called dynamic resistance. We just broke above it for the first time since mid-February. So if price slips back below and closes there, the next magnet is the psychological 5,500 level. But if we can stay above and punch through that to the next dynamic resistance level, which is the 200-day moving average, that's that red line we see right about here. That path is going to open us up to a nice round 6,000. So keep those levels taped to your monitor. So let's go over now to Apple. And notice Apple's reaction after Thursday's earnings call. Here's Thursday. So after that earnings call, the price slid from about 213 down to about 205 on Friday. And also volume spiked hard while the stochastics sank and crossed over. So here's down here your stochastics. And again, it kind of crossed over right here, looking like it's about to exit that oversold territory. So instead of seeing a neat little bull flag, we might just carve out a short-term descending channel. Some of the key levels to watch: that psychological 200 line, which also lines up with the falling 20 SMA on this time frame. And if you can see the 20 SMA right here is lining right up with that psychological level of 200. And if buyers step in and we print a reversal candle on lighter volume, that could signal a snapback to fill that gap at 206, 209 that happened after those earnings. But if the 200 cracks on heavy volume, the next magnet sits near about 194, which is a support resistance area back from early April. So for you short-term traders, keep alerts around those zones and let's the price action confirm the story. Now let's go over here to the VIX. Looking at the VIX, this is our fear gauge. So far in 2025, the VIX has pushed, whenever the VIX has actually pushed up above 30, which I've highlighted with that purple line right there, it's usually hinted at another 1 to 2 days or so of choppy selling before the market finally steadies itself. In other words, the first spike hasn't been the all clear. It's more like a starter pistol for one last bout of nerves. Once the VIX rolls back under that 50 or that 30 line on declining volume, that's when we've seen the S&P begin its rebound. So keep that sequence in mind the next time headlines start flashing market in free fall. And the real tell is whether volatility begins to cool off, but not the initial pop. So now we're going to go on a bit of policy and politics. So President Trump's tougher tariff regime may be controversial, but the stated goal is simple. Level the playing field for the U.S. manufacturers, keep supply chains closer to home. You know, markets hate uncertainty. We've had plenty of that while the rules were being written. Now that the playbook is clear, money managers can stop guessing and start modeling. And that dovetails with the Department of Government Efficiency, or DOGE, spearheaded by Elon Musk. They claim roughly about $160 billion in spending cuts since January. Elon steps down later this month, but the plan to trim the federal waistline by about 15% lives on. Less government waste, more private sector mojo. The market generally smiles at that. And hey, hats off to Musk. You know, he's running SpaceX, Tesla, X, or Twitter, as they call it, and cabinet level cost cutting shop as well. I get winded just thinking about it. Now, under your mental checklist for this upcoming week. Monday, we have factory orders in the morning. Tuesday is consumer confidence plus the JOLTS report, both mid-morning, obviously, depending on your time zone, and day one of the FOMC meeting. On Wednesday morning is the second estimate of Q1 GDP. Then in the afternoon, we'll get that FOMC statement and Powell at the mic right after. And then Thursday is the weekly jobless claims in the morning. We also get earnings sideshow with Palantir before Monday's open. AMD is after Tuesday's close and Disney on Wednesday night. So if tech wants to keep leading, we'll need to see at least a couple impressive numbers in those. So how do we trade this kind of market? Tariff headlines, Fed uncertainty, breakout ready charts. This is exactly why we drill the basics week after week. It's what keeps our blood pumping and what traders live for. And this is also why homework really matters. So remember, we forecast. We don't gamble. This isn't Vegas. Plan the trade, size the risk. Let the chart confirm the narrative, never the other way around. Stick to those three, and you'll sleep better than most pros on Wall Street. All right, Ghost Traders, you are officially up to speed. If this breakdown lit a fire under your screen time thumb, do me a favor, share it with your fellow Ghost Trader charting geeks and make sure they got it. So trade smart, keep it fun, and may the forecast be forever in your favor. So this is Angelique signing off, and I'll see you all later this week in our live session. And until then, happy trading.